What's up, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. As always, I'm your host, Cody Laughlin, and joining me today is our very special guest, Mr. Garrett Griffin. Garrett, good morning. How are you?
Good morning, Cody. Thanks for having me today. Super excited.
Absolutely, man. I am equally as excited and ready to jump into your very special, specific skill set here. But before we get into that, tell listeners a little bit more about you. Garrett is an approved deferred sales trust trustee and believes that private capital remaining under family control does more to serve the needs, goals, values, and objectives of their family, their causes, and society as a whole, rather than passing 35 to 45% in taxes to the government. Amen, brother. Believe in that. So he believes you should have a plan for your future when there is so much at stake. That's why he helps you maximize your family wealth and reduce your risk. In 18 years as a tax and wealth strategies attorney, he successfully implemented plans that have resulted in significantly reduced estate taxes, removing highly appreciating assets from the client's gross estate, leveraging taxable assets into tax-free wealth, proactively establishing legal barriers between clients' personal assets and potential lawsuits, and deferring capital gains taxes on the sale of appreciated and complex assets. In addition to acting as a deferred sales trust trustee, Garrett serves clients through his law firm, Legacy Legal, and is the director of business strategies and advanced planning for Prevail Innovative Wealth Strategies. After graduating from Cameron High School, he received his bachelor's degree in business administration from William Jewell College in 1998. Garrett is a graduate of the University of Missouri, Kansas City School of Law, and was admitted to the Missouri Bar in 2001 and the Kansas Bar in 2006. Garrett and his wife, Mindy, have been married for 18 years and live in the Liberty area when they are not watching his sons, Gavin and Beckett, play sports. Garrett enjoys spending time traveling with family and friends. So love it, Garrett. Again, so glad you're here, man. Tell us a little bit more about how you got into this world of deferred sales trusts.
Yeah, it's pretty interesting in that, historically, when I first started practicing law, I was involved from really a transactional standpoint in terms of, I'll call it M&A deals, but it was, closely held businesses being bought and sold and representing both buyers and sellers. About 2 or 3 years into practice, realized that there was quite a bit of that was going to be my practice going forward, and decided to go back to school and got my master's in tax law. And so I was doing a lot of transactional work, also working closely with one of the senior attorneys at the firm that I started at doing estate planning. And so that was really kind of the combination of my practice was a lot of business and estate planning. And after I received the LLM, I ended up moving firms to more of a boutique law firm that actually had a heavy tax practice. There were several CPAs that were employees of this law firm. And so ultimately, while I was there, initially hired really kind of on the M&A side to come in, do deals, help with buyers, purchasing companies, help with the sellers, selling companies, and that type of thing. And, then kind of that '08 time frame hit, and some of those M&A deals kind of dried up a little bit. And so really pushed my focus more so into the estate planning arena. And that's really what drove my practice pretty much for the next 10 years or so. And so that was really kind of where I spent most of my time was, I'll call it even just a basic estate plan, putting together revocable living trusts and probate avoidance and some asset protection, those type of things, in addition to more even advanced cases. And so, our estate tax exemption has gone, up and down, over that, basically my whole practice. And so, it's been a moving target and a lot of unknown for clients. And that's really where I'd spent quite a bit of the focus in my practice. About 2 years ago then, so it would have been sometime in the 2018 timeframe, I was introduced to a group called the Estate Planning Team. And it was actually just really by mistake. I was doing a estate planning 101 seminar, And one of the attendees approached me and had a Google printout sheet from the web and asked me if I knew anything about the deferred sales trust. And I said, I kind of reviewed it and looked at it. And I said, well, I seem to understand the transaction. I said, but I really don't have any familiarity with it. And so that kind of started my desire to kind of learn a little bit more. I dug in, did some due diligence, reviewed that transaction, and ultimately reached out to the estate planning team and spoke with the principal there, who's Robert Binkley. And so developed discussions with Robert over time and learned more about the transaction and how, from my perspective, what could I be doing for clients and how would that benefit them, and what could my involvement be with the EPT. And so the EPT effectively is a membership organization, but the EPT is partnered with a gentleman by the name of Todd Campbell, who is essentially one of the authors of the Deferred Sales Trust. And so Todd is a tax attorney. He has his tax practice in the Lake of the Ozarks, which is kind of central Missouri. And Todd effectively designed and came up with the structure about 25 years ago. And Todd then partnered with the EPT. And like I said, the EPT is kind of a membership organization of attorneys, CPAs, real estate brokers, business brokers, qualified intermediaries, real estate investors, RIAs. And so, really kind of anybody in that professional and financial services arena, they can be members of the EPT. But basically the EPT, along with Todd, they market and maintain the infrastructure that's necessary to support these deferred sales trusts. And so in my discussions with both Robert and Todd, I ultimately decided that I wanted to become one of their approved trustees. And so, as we get into kind of how the structure works, effectively, you have to have an independent trustee in each one of these transactions. And the estate planning team, to make sure that these transactions are not only viable, but over the course of time in the life of the trust, that they remain intact, and that all of the compliance things that are supposed to be happening with these are happening. And so they want to make sure that the trustees that are involved in those situations are trustees that they've vetted, trustees that they've trained, and trustees that understand then the mechanics. And so ultimately I decided that trusteeship was a good fit for me, based upon some of my history, not only from the estate planning side, but also being a tax attorney as well. It looked like something from my perspective that, with what is probably obviously going to be one of the largest wealth transfers in the next 20 years, the number that I see, it's always all over the place, and it's probably always understated, but it's anywhere from 45 to 100 trillion dollars, or some of the various estimates that I've seen. And so it seemed that there was a lot of business succession planning that I was doing as part of my practice. And it made a lot of sense that it coupled nicely with that if a client is exiting a business, that potentially the deferred sales trust would be an avenue for clients. Ultimately, what I found is that the applicability of the deferred sales trust ends up being much, much broader than I probably had initially given it credit for. And so the more that I've learned, the more that I've seen where it has applicability and potentially could save client taxes. And so to me, it was a natural fit with kind of the legal side of my practice in terms of where that career had been. But there was also something intriguing about it where, from my perspective, only having been introduced to it in 2018, it seemed that there was still a lot of advisors, individuals that are offering professional services that don't know about it. And so it seemed like a great opportunity and a great fit with the things that I was doing, kind of in my career and for the clientele that I've been serving.
That's awesome, man. And I love that. And I'm so glad that, we had the fortunate pleasure of getting connected with you a couple of weeks ago. And obviously I'm really excited that you're a part of this Prevail Innovative Wealth Strategies team, phenomenal team up there. Our friend Adam Dorn and his group
Yep.
up there. Love what you guys are doing just to help educate people, investors like ourselves on how we can utilize these very powerful tax advantage strategies to help not only grow and preserve our wealth, but how do we continue to make it generational, right? And
Absolutely.
like what you mentioned, estate planning, things like that. How do we pass this down to our heirs that can continue that? So again, just really, really excited to have you here today talking about this exact conversation. So, and that's what the show's about here. And I hope that for any first time listeners that may be tuning in and they're hearing about this topic and they're like, wait a minute, I thought I was going to learn about apartment investing. The goal is
Right.
for,
Right. Yeah.
our show is definitely designed to help educate people on how in our world about investing. But we feel like part of that is having financial literacy and understanding, again, how is this a generational wealth tool? How are we?
Absolutely.
Yeah. And then how do we use these tax advantage strategies to our benefit? Because ultimately, at the end of the day, it's not about how much money you make. It's about how much money you can keep. Right. So.
Right. That's exactly right. And I think that's a great point. And I really think that, like I said, in terms of kind of how I ultimately ended up working with the estate planning team and becoming one of the approved trustees, as I was looking at the planning that I was doing for clients, it really is more on the legacy. It's the wealth transfer component. And I started kind of looking at my practice saying, okay, what can I do more on the front end while clients are still alive, and how do I tie maybe those two things together? And so really what has happened with my career is not only, from my involvement with the EPT, is that you mentioned Prevail, Innovative Wealth Strategies. And so my involvement with that group in terms of being the director of the business strategies and advanced planning, ultimately what I see is that, how do we assist clients and give them tools and give them solutions on not only the accumulation of wealth and doing that in a tax efficient manner, but then ultimately, as that cycles around and clients are, maybe not necessarily retired, but entering into pre and post retirement, how do we then make sure that the distribution phase is also tax efficient? And ultimately, and then again, and this is where, historically my career has been, is, well, then how do we efficiently transfer the wealth to that next generation in some kind of a protected manner so that we have those types of things in place? So it really kind of becomes more full circle on, the accumulation, distribution, and ultimate wealth transfer. How do we do it tax efficiently? How do we do it in a protected mechanism, not only while we're alive, but then also how do we protect for the beneficiaries as well? And so that's kind of how I've seen, my particular career evolve, and kind of how I got involved with these different organizations was really, how do I become more valuable to, the clients that I serve, but also the other professionals that I work with in terms of kind of those various phases. So, like you said, people will tune in and think, oh, well, yeah, I thought we were learning specifically about, real estate investing. And we do have some specific things with that on the deferred sales trust, but ultimately it really is, it's how do I accumulate the wealth, spend it when I want it. And then ultimately, if I'm generating enough wealth, most clients want to pass that on to, surviving spouses, children, grandchildren, et cetera, and, really kind of create a legacy as well. And so that's really where, my involvement with the EPT and Prevail kind of circled back and kind of connected then ultimately with kind of the legal practice that I'd had for, 18 years.
Mm-hmm. Yeah, I like that. And I like what you referenced to a few minutes ago about, putting these strategies in place now versus later down the road, right? And being proactive now. And I think that's so important because, you never know how much time we have left on this earth, right? You never know, any circumstance can happen at any given point in time in your lifespan. And it's always so much easier to be more proactive and have these things in place now versus just in a time of crisis. So
Absolutely.
Yeah. So
You
I
know,
appreciate that.
yeah, absolutely. Any time, and you know, this has been my experience throughout my practice, and I'm sure of just about anybody else, is time is your friend when you are proactive.
Mhm.
And it's hard to find the right solutions if you just start thinking about the planning at the 11th hour. And, you know, a lot of my practice has been revolved around business succession, you know, family businesses that are, you know, trying to transition that from one generation to the next. Well, the more time we have to be able to put and implement those things into place, the better off we're going to be. We're going to have more tools available to us, you know, and so, like I said, and you know, you're exactly right. I think, you know, time is your friend, and you know, now more than ever, I think we all are a little bit more aware of our own mortality. You know, in the midst of this pandemic, and you know, my estate planning practice has really kind of been turned on its head, because I, you know, having practiced for 18 years, I've got, you know, 1,000 clients or so, and you know, 15-20% of them have reached back out in the last 6 months and said, hey, you know, with everything going on, I sat down and I looked at my plan, and you know what, things have changed since the last time we did that. And so, you know, we need to make some updates, you know, just in case something happens. And then you've got those that don't have any plan at all, who have sat down and kind of thought, boy, I don't have anything in place at all. I need to do some planning. And so, you know, with the pandemic, with the fact that we have, you know, the election that is, you know, somewhat still up in the air here, you know, there's a lot of unknown. And, you know, I think that's caused clients to kind of reflect and think about, what is it that I'm doing? What planning do I have in place? If I do have some in place, is it current? You know, is it what I want to have happen? And inevitably, when clients go back in and review things, they, you know, they think, oh, well, yeah, my family circumstances have changed somewhat, and so now I'm maybe going to be doing something else. You know, as we think about just, you know, the individual planning, as we move and kind of are thinking about where maybe there's more applicability to the deferred sales trust, I think we're seeing one uptick in sales transactions, and certainly from the business standpoint, where, you know, clients have, you know, worked a lifetime to create a business, and now with all of the factors and maybe unknowns that are going on, they're looking at it saying, okay, what's the valuation of this business? Has it been affected by the pandemic, by the election? And if so, was it a negative impact, which is the case for a lot of businesses? Certainly, there have been some that have been able to succeed based upon some of these niches. But you look at the overall and you say, okay, well, there was a negative impact, and maybe there's even a negative impact in my industry. And so, what is the viability of my business going forward? Maybe I had an exit strategy that was maybe a 10-year horizon, and now I've accelerated because of the risks. I'm not comfortable, you know, maintaining those risks anymore. And so you see that a lot with not only business owners, but real estate investors as well, making moves and making adjustments. And there is, I think, a lot of opportunity when you have the unknown, because I think we are going to see an uptick in transactions, both from the real estate side and the business side. So to me, there's a lot of opportunity that is coming, and again, the applicability of the deferred sales trust to many of these situations is pretty paramount right now. And again, I think with some of those unknowns, you know, clients are much more in tune with what's my timing on my exit strategy, and so we're seeing that a lot.
Mm-hmm. Well, that's a perfect segue into kind of diving in deeper into this concept of deferred sales trust. Is, you know, this is a newer term for me. I just learned about this strategy last year, and you know, it's still very foreign to me as well. But obviously, has some powerful advantages. So I'm hoping that we can dive into that, pick that apart, and talk about really how does that benefit us as real estate investors. So I guess kind of let's lay the framework, if you will. Talk to us about like the very basic about what exactly is a deferred sales trust.
Yeah. So from an applicability standpoint, I think first what's important is what are the transactions that we're kind of talking about as we start to think about how it applies. And what we're talking about really is the sale of any highly appreciated asset. So, it could be an asset where you bought and the fair market value has appreciated over time. It could also be an asset that you bought that you have taken depreciation on over a period of time. So for the real estate investors, that's really kind of something that hits the nail right on the head. So you're buying into properties, you're taking depreciation over some very period of time, and at some later date now you have an adjusted basis that is much lower than the fair market value of the property. Businesses sometimes, certainly there are some aspects of depreciation, but a lot of times, we have business owners who they've started these businesses from scratch. So their basis in their company is very, very low when they go to sell, and the business now is worth, X. And so it's grown in value of some multiple. And so now they're getting ready to sell. So we're talking about, again, really any highly appreciated asset. The two general categories are businesses and real estate, but real estate could take on numerous different categories and types of structures and character of those particular assets. And so it's not just necessarily, I own this building directly or in an LLC, let's say, but it could be partnership interests, syndicate interests, all sorts of variations. It actually even applies to personal residences. So, there's a 121 capital gain exclusion for the sale of a primary residence, but it caps out at $500,000 between husband and wife. And so if you've got a capital gain transaction, even in the sale of a personal residence, there's some applicability there. Living in the Kansas City metropolitan area, you don't have a lot of huge appreciation like that on personal residences like you kind of do on the coast, where the value of real estate is considerably higher. But certainly there is that applicability. Art, collectibles, those type of things that highly appreciated are also something that we can apply the deferred sales trust to, as is concentrated stock positions that have highly appreciated. So the applicability, and again, this is where maybe initially when I looked at it, I didn't give it all the credit that it probably deserved, and how broad that might be. And the things that is also interesting as we kind of get into it is that for real estate investors, historically, they've had a 1031 exchange that is a tax deferral mechanism. But businesses really haven't had that same applicability. There's no additional code section really, for the most part, in the code that says, business owners, you sell your business to a third party, but you use an intermediary, and then you can go acquire a new business to defer. There's just that mechanism really doesn't exist, similar to what the real estate investors have. And so again, the applicability then of the deferred sales trust is pretty important. And so again, we're talking about highly appreciated assets. So effectively, the deferred sales trust is a capital gains and certain depreciation deferral mechanism. And it is all based upon Section 453 of the code, which surrounds installment sales. And so if you want kind of a succinct definition, it really is a privatized installment sale using Section 453 of the code. And so what does that mean? Basically, what we're doing is for each transaction that wants to enter into a deferred sales trust, there is a third-party trust that gets created for that client and that transaction. That third-party trust, and where basically I come in as a trustee, creates this third-party trust to effectively act as an intermediary in the sale of the asset. So client sells the asset effectively really to the end buyer, but the asset goes into the deferred sales trust first. So the trust essentially purchases the asset, and then turns around and sells to the buyer in a contemporaneous closing. All of the reps and warranties from the seller go still directly to the buyer, but we have this intermediary spot where the asset hits before it goes on to the end buyer. So, different from a true seller finance transaction where the seller is financing for the buyer. In that type of a situation, the seller is taking on all sorts of risk, because we're really thinking, okay, well, the buyer has to either maintain this property or maintain this business and use the cash flow to pay me back. And so there's risks there. Your collateral is still probably the business or the real estate. So in this situation, buyer is coming to the table with their own financing. And so they've either gotten their own loan or they've got their own cash. And so what happens then is when the trust in that contemporaneous closing sells to the end buyer, the trust is going to receive the gross sales proceeds. Obviously, you're going to have some closing costs, commissions, and those type of things, but effectively, you're getting the gross proceeds sitting at the trust level. So at this point, what's happened? Seller sold to the trust at fair market value, and the trust turned around and sold to the buyer at the fair market value in that contemporaneous closing. So from the trust perspective, the trust bought and sold at essentially the same price. So there's no tax at the trust level. But for the client's perspective, when they sell to the trust, they are entering into a promissory note with the trust. So the trust owes them the money back. And so then there is the creation of the promissory note. And again, that creation of that promissory note is built on Section 453 under the installment method. So the client sells to the trust sells to the end buyer, and now the trust ends up with the gross proceeds. The promissory note then, and there's a lot of flexibility here as to how it ultimately gets structured, but let's just kind of use a typical situation that we see. Client sells to the trust, and the promissory note that they take back is a 10-year interest-only promissory note. So what are the mechanics and what are the tax then with that piece of it? Well, when the client sells to the trust, if they do not receive any principal in that closing or initially out of the terms of the promissory note, they're going to maintain and keep tax deferral. So the capital gains tax or depreciation recapture that potentially would have been due in a normal taxable transaction, we're deferring that. So we don't owe that capital gains tax or that depreciation recapture at the time. So the trust then, because of that and its ultimate sale to the buyer, the trust is going to maintain the full gross proceeds of the sale. And that ultimately becomes important because, again, let's go back to the promissory note. If client then has an interest-only promissory note, they are going to receive interest income from the trust based upon the rate that they set in that promissory note. So if the client says, well, I want an interest-only note for 10 years and I want 8% interest, the trust is going to pay them the 8% interest on an annual basis. That promissory note payment, then that interest-only payment, that's ordinary income to the client. So, very similar that if we were in a normal taxable transaction and I end up with my net after tax proceeds and I give that to my investment manager and, they're basically getting interest income and dividends and those type of things as ordinary income, that's the same. But what is different in this situation is that prior to the closing of the transaction, the client, trustee, and the client's investment advisor basically are going to get together to be able to come up with an allocation of the portfolio post-closing. So the investment manager knows that, okay, well, if I end up with the gross sales proceeds and we invest it accordingly in these types of investments, and this is the type of return that we think we can get, that then allows us to set the terms of the promissory note. And in particular, what is that interest rate? Now, obviously, there's going to be some internal costs with the trust. There's tax returns, there's fees, et cetera. But so we look at that and take that into calculation as well when the portfolio is getting put together. Now, I, as the trustee, I'm not driving the portfolio decisions, and I'm not an investment manager, and I'm not making those decisions. As the trustee of the trust, I am effectively custodying those assets. And the importance is, because it is a third-party trust and a third-party trustee that is holding the proceeds from the sale, as long as the promissory note is still interest only and there's no principal payments yet, the client has no constructive or actual receipt with regards to any of the principal of the sale. And that's how we maintain the capital gains and recapture deferral, is that the client hasn't had a recognition event yet. They've effectively sold, but because we sold to this intermediary that is holding the proceeds, that trust, we effectively don't have a recognition event, and we're not getting hit with constructive or actual receipt where the IRS would say, oh, well, you have had a recognition event because of this. And so the importance of the trust and how it's structured and the independence of the trust and trustee is pretty paramount, because we don't want that constructive or actual receipt to be an issue. And so where you really start to think about, well, what is the benefit then? So if you think about, approximately a $5 million transaction, that if there's very low or little to no basis, where you've got a $5 million capital gains and the liability associated with that, you're somewhere in potentially the 20 to 25% taxable range, assuming we're not talking about depreciation recapture. And so then you'd be up to ordinary rates. But if we're looking at that in that type of situation, you say, okay, well, now we may have $2.5 million worth of tax that may be owed based upon a $5 million transaction. And so the importance and really where the benefit really starts to kick in is you say, okay, well, instead of paying the government the $2.5 million in tax, the full gross proceeds are sitting at the trust level. So, let's just say 5 million for the math. You say 5 million is sitting there. Well, that means that the investment advisor, he doesn't have $2.5 or $3 million to invest. He's got $5 million to invest. And so if we think about a 10-year promissory note, that means he's got that extra $2.5 million to invest over a 10-year period. Well, if we're getting 6, 7, or 8% return back to the client, that's pretty significant over a 10-year period, because we've maintained that deferral. Money that we otherwise would have paid in capital gains tax to the government, we've maintained in the trust, and the client is effectively getting an income stream off of that. So, that's really where the big bang is you say, okay, well, the longer I can maintain that deferral and continue to earn off of that, well, the better off I am, the more wealth that I've created over a period of time. And so if we think about and kind of talk just a little further on the promissory note really, from the client's perspective, it's the client's ability to control when and if I want to pay that tax. When do I want to trigger principal payments to me? Then I have my recognition event. And when I had the recognition event, then I know I'm going to owe the tax. So I had kind of said, well, the best situation, and one that we see the most, is a 10-year interest-only note. Because as I get my interest income payments, obviously that's ordinary income that I pay tax on. But if I don't receive principal payments, then I don't owe any capital gains tax. I maintain that deferral. Now, some clients may say, well, you know what, maybe I want to get a little principal over time. And maybe they do a straight amortization. They say, well, I want principal and income. And again, this is right along the lines with the installment method. And that means as they receive those principal payments, that's a portion of a recognition event. And so they'll pay capital gains tax on the portion of the principal that they receive in that given tax period. And so, they could say, well, by the end of the 10th year, I've received all of my principal back. I've received interest income over that period of time. And so at the end of the 10-year period, there's nothing left in the trust. It's paid everything back to me. And, the trust basically dissolves. And so there's that flexibility there. The other thing, though, is that there's the flexibility and again, where this time, the time value of money and being able to continue to invest, kind of the delta, which is the tax otherwise paid. If we get to the end of the 10-year period and the client did a 10-year interest only note, we get to the end of the 10-year period, the client can say, hey, you know what? This is a pretty good deal. I don't want to, it's going to balloon. I don't want it to balloon. Let's renew the note. So we renew the note for another 10-year interest only period. And you can continue to do that in successive 10-year periods to continue to maintain the deferral. So again, you've got that delta that you are investing and getting cash flow off of that in terms of that income stream. And again, you can do that for successive 10-year periods. So the deferred sales trust actually, so it's been around for about 25 years. And what we're seeing now is promissory notes going into their third renewal. So they got down to the end of their second 10-year period and they've renewed it now. And so we've got notes that are going basically into their 30th year. And so again, the power is that if you don't recognize that principal payment, you continue to maintain that deferral and you're getting, again, the use of that delta that you otherwise would have given to the government. So the amount of wealth over that 10, 20, even 30-year period that you can continue to generate over just on that delta is pretty significant. And so again, when you start to think about, from an investment standpoint, if somebody's selling real estate or selling a business and that type of thing, there's quite a bit of power in that. One of the other things that I wanted to comment, though, is clients will say, well, is it an all or nothing type of deal? I got a $5 million property. Maybe I do have a little bit of basis. Maybe I've got 500,000 or $1 million. Do I have to put everything from the sale into the deferred sales trust? And the answer is no. You can really carve out whatever it is that you want to take back personally in a particular deal. So just being aware that, okay, well, if I've got, let's say $500,000 of basis in a particular property that I'm selling and want to use the deferred sales trust, I could say, well, I'm going to take my basis off the table. I'll take that principal. And because I have some basis, I don't owe any tax on that. And I'll let the excess of what would have been the capital gain in that situation, that's what I'll put into the deferred sales trust. So you have that flexibility to do that. And you could even potentially say, well, maybe I've got a $10 million deal. Maybe I don't have much basis. Maybe I do have some basis, but I want a couple $1 million. And I know that part of that is going to be taxable. Part of that, because of my basis, I'm going to have a taxable gain on that $2 million that I receive. And I know I'm going to pay some tax on that, but I want some of those funds personally. And then you may say, well, then the other 8 million can go into the deferred sales trust, and we're still saving quite a bit on taxes there, and we can continue to invest that for cash flow. So it's not an all or nothing type of thing where there's a lot of flexibility in how much of the purchase price I want to allocate to the deferred sales trust. How do I want to structure my promissory note? So there's quite a bit of flexibility in there. And again, ultimately at the end of the day, the reason we're using the deferred sales trust is, yes, it's tax mitigation, but it's really control. It's a control element. When do I want to pay the tax? And so in that flexibility of the promissory note, there's quite a bit of leeway in terms of being able to do that.
Yeah. And that's one of the things that we're attracted to as investors, right? We like control. we like to have control.
Absolutely. And so, as you think about kind of that potential for the continuous renewal, again, that's where just even, over time, the power is there. So then, one of the questions then that comes up a lot is, okay, well, what happens when the seller, who is the client, what happens when they pass away? Well, there's no step up in basis on the promissory note, but the promissory note is still a promissory note. It's still viable. It's still intact. It is part of the estate of the seller still. So it's just like any other asset that you would have as an individual, in that promissory note becomes part of your estate. So clients need to make sure, if they do have a promissory note being paid from the deferred sales trust back to them, that they've taken the appropriate measures to make sure that they have some basic estate planning in place with like a revocable living trust, that then the note moves into the revocable living trust at death. And so what happens at that point in time is that the heirs ultimately have some flexibility. So the heirs could say, okay, well, here's this promissory note that we now own. We can leave the note intact and basically step into the shoes of likely the parents and say, okay, keep paying us the interest income. We'll keep the note intact. We like the interest income. There's no reason that we want to pay that capital gains tax at this point. So we'll continue to defer just like mom and dad did. You'll have some clients who may say, hey, this is great. It's a windfall to us. We know that there's going to be a tax due. So we're going to kind of collapse the note and take our principal, and then we'll have as beneficiaries that recognition event, and we'll owe the capital gains tax at that point in time. And so the heirs, those beneficiaries, are going to basically step into the shoes of the parent, and they're going to have those same options of control over when and if we pay that capital gains tax. And then kind of in addition to that, then there's also some back end tax engineering that we could put in place that potentially could even offset and alleviate some of that potential income tax for those beneficiaries. But that's a pretty specific topic. But there are those mechanisms that we look at as to how do we know that there's this, this ongoing potential gain that we're deferring at some point. When and how do we pay it? And we start looking at, okay, well, one, do we want to pay it when mom or dad dies, or do we want to continue to let it roll? And if we do want to pay it, then how do we engineer that? And so that, that's all part of that kind of planning process, as well as you're kind of getting into the note over the time and to see how do we want to do that. But ultimately, that's kind of some of the things that we're looking for there.
Gotcha. So Garrett, let's kind of go back and let's kind of summarize this, because we covered a tremendous amount of ground here really, really quick. So
yes.
So I have, instead of in a transaction event, i.e. like our case, we're selling real estate. Instead of there being two entities, myself and the buyer, we're adding a third entity, this trust, that is actually the one conducting the transaction, if you will. So I'm selling the asset to the trust. The trust is then selling the asset to the new buyer.
Yes.
But I, the seller, am setting up a pretty much essentially a contract between the trust in a way, or like you said, a promissory note between the trust.
Yeah, which essentially is a contract. Absolutely.
It's a contract, right? In which I determine how I want to receive those proceeds from that trust, from that transaction, right?
That's exactly right.
Awesome. And so when is this strategy not a very good place? So like, I guess I'm thinking about the velocity. We talk a lot about velocity of money, right? Keeping transactions flowing, whatnot. Especially, I guess, for maybe younger entrepreneurs who are just getting their portfolio going. Is this a beneficial strategy to utilize if my goal is to continue to transact and acquire more assets?
It is. And so how that works, and kind of as you start to look at that, and that it really plays well into, I think, the discussion, especially from the real estate investor standpoint, when we look at the deferred sales trust potentially compared to a 1031 exchange. And so what happens, and you're talking about the turnover rate, one of the first things, though, we still look at is, because there are costs with the deferred sales trust, we need to know that there's probably some minimum levels of capital gains tax that we are deferring where this might make sense. And so kind of the rough numbers, and it's not an exact science, but the rough numbers are, I probably need to be deferring $250,000 worth of capital gains tax. And it probably needs to be at least probably a $500,000 transaction. So those are kind of just some of maybe the floors that we're dealing with from a dollar amount, to where you say, okay, well, really need to be in excess of that because of the internal fees, we want it to economically make sense. And so that's kind of some of our minimum threshold levels. Even though, again, I've seen some do it for less just based upon some particular situations, but ultimately that's kind of just some numbers that we look at. But for somebody who is not making what I'll call their sunset exit, somebody who wants to go back into new deals, what is interesting about this is, so again, the client is working with their financial advisor with regards to the allocation of the portfolio. Normally, if we're, and even if we're doing, interest only note, no matter what there, but from the allocation of the portfolio, normally we may just be looking at maybe like an endowment type of a model to generate our interest income that we're going to pay back on the promissory note. But again, that may be probably more for somebody who is in their sunsetting, where I'm selling out and I'm not worried about going back into a new deal. I just want some managed money and I want that return. For those that are not there, that allocation of that portfolio, the client as the creditor in this situation, so that contract that we were talking about, that promissory note, I now am, as the seller, I'm the lender and I'm the creditor in that situation. And the portfolio is basically my collateral. So it's a non-recourse loan. I can't go out and find other collateral that the trustee may have or that somebody else may have. My collateral is the assets in the portfolio. So I am able to dictate what that portfolio allocation looks like as the creditor in this situation. So when we were talking about the investment manager managing that portfolio, that's really what we're talking about. But the client may say, well, you know what? I want to go into a new deal. I want to buy a new business. I want to buy additional real estate. I'm not in that sunset. I'm active in what I'm doing, and I'm active in growing and doing multiple transactions. We can take up to 80% of the trust fund and go into what I'll call more of an active deal. So just, not managed money. We need to maintain a kind of a 20% margin there because we do have those internal expenses of the trust, and we potentially would maybe need some liquidity for other reasons. And so kind of the threshold that is used is this kind of 20%. But basically 80% of the trust could be put into what I'll call New Deal LLC, likely going to probably be an LLC, limited liability company. And that LLC then can buy a new business, buy a new piece of real estate, go into a syndicate and do these other things. And so what happens in terms of the structure, the trust with that 80%, so that's basically what I call capital contribution to the LLC. The trust is going to be a 20% preferred member of the new LLC. Client is going to be the 80% managing member of the LLC. So we can fund that LLC with up to 80% of the trust to then go out and acquire that next asset. That LLC can also use leverage. So we're not restricted to just 80%. We are from the trust investment to the new LLC, but the LLC can go get leverage and debt to buy a higher valued asset if that's what they want to do. But there's flexibility there in that situation. So here's where I think this is a good segue to say, okay, real estate investors, what is the difference between a deferred sales trust and the 1031 exchange, and where might the deferred sales trust be more beneficial? And obviously now, again, from a political standpoint, not to be political, but if Biden does ultimately end up as the president, he has potentially listed the 1031 exchange as something that they may go after. That and some numerous other things, but that potentially from the real estate investor standpoint, it's maybe in the crosshairs. At least it's been talked about. So if we think about the 1031, and not to dive into all of the detail there, but generally in the 1031 exchange, it too is a deferral mechanism. And in that situation, though, you've got all kinds of rules, restrictions that potentially make it not incredibly attractive. And so when you close on your property and the money is sitting at the qualified intermediary, obviously then you have time restrictions on identifying your next purchase and then ultimately closing on that next purchase. And if you don't get that done, then you've blown your 1031 exchange and you ultimately have to recognize the capital gains tax that you were hoping to defer. In those situations, assuming I can identify my next property and that I'm going to close on it, if I've taken depreciation on my previous purchase, my basis carries over with me. So if I've gotten now a low basis, which likely you are, because that's why you're going into the 1031 exchange, that low basis carries over into the new property. And so if I don't go out and buy a property of more value to get extra basis to depreciate, I basically have just maintained my deferral. And so potentially that is an issue. The other kind of on the economic side, as you're kind of looking at this and you're saying, okay, well, I was selling this property because I kind of thought I was at the height of the market. And so it was a good time to sell this piece of property. Well, guess what? The time frame of the 1031 is so constricted that likely when you go into the next property, you're buying at the height also. So the timing is so condensed that you're buying high, you're selling high, but you may be buying high as well. So you really don't have the ability and the flexibility to say, I'll buy my property when I want to buy my property, so that I can truly identify where an opportunity is at. That, hey, let's wait 6, 8, 9 months when we think the market's going to do this, or there's a particular property that we think we might be able to get at a lower value if we could wait it out for some period of time or something like that. And so you don't have that flexibility in the 1031 exchange because of all the time restrictions that are required for you to identify and close. And again, we've got low basis that carries over. So where's the deferred sales trust an alternative, and where is there some additional benefit? Well, if we go back to new LLC, we're taking 80% of the trust fund to invest back in LLC. Whether or not we add debt or not is kind of irrelevant. But if my example before was a $5 million in the trust, we can take 80% of that trust fund and go back into that property. So on a $5 million deal at 80%, so we can take $4 million. We can take $4 million and go into new LLC. Well, if you think about your 1031 exchange and that low basis moves over, I've got to buy, again, this property that's more valuable than the one that I just got rid of. In this situation, when we go and we've got $4 million at the new LLC, if we don't even put any debt, if we got a $4 million property, what we see is we'll go in, there'll be a cost segregation done on the new property, and we can depreciate the whole purchase price starting again. So pretty significant difference of, instead of carryover basis in a 1031 exchange, if I go into a new property, I get to start my basis recalculation all over again at whatever we buy in at. And then if you've done your cost seg, then we can say, okay, we're going to allocate then, and we're going to try to depreciate those other assets more rapidly based upon the cost seg that we did on our $4 million property that we just bought. And so for the guy who is the one that wants to move from deal to deal, getting to restart that depreciation all over again is huge, because they are an 80% managing member of the deal. So 80% of the depreciation is going to flow back to them. Mm-hmm. So if you think about it, and this is kind of a little bit of a triangle here, and at least visually, is I've got the trust paying interest income to the client. So their client is getting interest income. Now, the trust that owns the LLC, that LLC is producing now this new depreciation. And I, as the promissory note holder, because I'm the 80% member, I'm getting a big chunk of that depreciation. So now I'm offsetting the interest income that I'm generating. And so having the ability to reset and restart that depreciation schedule is pretty powerful. And again, if you've done the cost segregation, what happens then is once you depreciate down to low again and you're ready to go into your next deal, the LLC sells and does a new deferred sales trust. And we start it all over again. So we have the ability to continue to recycle over that period of time. So if I'm looking at it and I'm saying, okay, well, if I got low basis and I'm trying to do 1031 exchanges, I got to keep buying higher and higher and using more debt to get more basis to depreciate. You don't necessarily have that issue with the deferred sales trust. It's more flexible in that, hey, whatever we buy in at, even if I only use a couple $1 million, I'm going to have a couple $1 million of depreciation that I get to start. I don't have to worry about carryover basis again. It's whatever fair market value that we buy in at and whatever we can depreciate off that purchase, it starts that over. So pretty flexible and powerful, because then once you're done depreciating and you're ready to move on to a new acquisition, you just do it again. That LLC sells to a deferred sales trust, and we start that all over again. So pretty powerful from that standpoint in terms of being an alternative to a 1031. One, I think the economics are probably better with that depreciation start over, and we don't have the time limitations on being forced to buy a property when we may not be ready. Right. The beauty of the deferred sales trust is that, hey, you're 45 and you're 180, all those time restrictions, those go away. We go into the new property when we've identified the one we want. And that's it. And it's not based upon, we've got some time restriction that's forcing us to purchase something that maybe we want it, maybe we don't. This gives us, that basically is irrelevant, and that factor's gone. And it's really, are we getting the property we want at the price we want? And is that timing right? And so if that's the case, then okay, then the economics make a lot of sense with then the fact that we're getting to restart our depreciation schedule all over again too.
Oh yeah, see that itself, that's mind blowing, because I had not heard that aspect of the deferred sales trust, and I'm like, holy smoke. So it really comes down to, number one, most importantly, the control. The flexibility that you have, right, as opposed to the 1031.
Absolutely.
And then now this added benefit of being able to benefit from a new depreciation schedule, which is, like you said, just recycling.
You're recycled. Yeah. You get done depreciating and you say, hey, we've identified another property that we may want. Well, let's sell this one. And we just basically roll it and go back into another deal. So pretty powerful there.
I love it, man. This is phenomenal. So let me ask you about one other aspect of the 1031 exchange that becomes a little bit complicated is in a syndication deal where I have multiple partners in the deal and we have this big taxable event that we want to offset. So we're looking at 1031 exchange. It can be done, but in general, as I understand it, is in the majority of the partners either have to agree to go into the 1031 exchange collectively, or you have to go through some legal nuances or whatever to get around that.
Right. And so that piece of that goes away, because as a syndicate or, a partnership interest or whatever the case might be, I individually can decide what I want to do with my interest that is not 1031 related. So if I want to go into a deferred sales trust, I can do it with my portion. I don't need approval, from other parties, other than I just need to make sure that the appropriate language is put in the definitive agreements. And it is very, very similar to a 1031 exchange language that you see on real estate contracts. That's effectively the same language that we use for the deferred sales trust, is that, hey, the buyer of this property is going to allow me to enter into a deferred sales trust. They're consenting as long as it doesn't cost them anything. Gotcha. And ultimately the reps and warranties of everything that we're doing in those definitive agreements when we sell, those are going directly to the buyer. So they're getting clear title. They're getting, with no liens, and they're getting the reps and warranties still. Those still tie directly from the seller to the buyer. But the individual within those syndicates or those partnership interests and those type of things, they can choose to go into the deferred sales trust with their portion and not affect anybody else. And nobody else has to necessarily agree that they, we all have to do this, or none of us can do it and that type of thing. So there's that flexibility.
Yeah.
Absolutely.
It's really interesting as we're going through this conversation, and we, you've explained very eloquently, by the way, all the benefits of utilizing the deferred sales trust. It's kind of interesting to me that we're not hearing more about this as compared to 1031.
It really is. And I think we probably will. I kind of go back and forth on, well, why is that? And I think it's, it's just like, I think really anything from a tax perspective. When somebody does something new, there are certain parties that are afraid of it, and they don't want to have any issues, and so maybe they just shy away from those type of things. And so it's been interesting that the number of transactions that Todd and the EPT have done over that 25 years, it's staggering. And so the viability of it, the fact that it's gone through IRS scrutiny. There have been, I think, about 15 what we call no trigger audits, which basically means that the client and their return, they were getting audited for some other reason, and they've gone through and went through those audits with no changes on the deferred sales trust piece of those transactions. So we feel really good about the viability from the IRS scrutiny standpoint. Part of, and this kind of goes back just a little bit to the engagement with Todd on the transactional side. Client enters into, when they get ready to close, what's called a conditional engagement with Todd and his firm. Basically, Todd doesn't get paid unless the deal closes in the deferred sales trust. So the client may get to, closing and say, maybe I don't want to do the deferred sales trust. And so ultimately there's no deal and Todd doesn't get paid. But assuming it closes, then it satisfies the conditional engagement. And on an ongoing basis, then in terms of what you paid Todd to do the deal and close it, you get audit defense on an ongoing basis from the firm. So part of that engagement provides that defense going forward. So, Todd and his group feel really good about the history, what they've seen from those audits, and the fact that this is truly viable. But it is interesting that, and I think that with Todd and the EPT, while the membership is certainly growing and it is becoming a little bit more well known, it's also been handled by a tax firm where they've said, well, we don't need to do this in such a huge volume that that everybody knows. I mean, certainly they're trying to educate, they're trying to build that, but it's been interesting that and that was kind of my feeling when I heard about it first time in 2018. I kind of thought, where have I been? But it's and that happens all the time, though. It's just one of those things that you don't know what you don't know. And if you're not truly out looking and searching for some of these things, if you're just super conservative, maybe you're not looking and that type of thing. But as we kind of looked at that it is starting to grow, and me being one of the more the newer trustees, obviously I'm marketing and talking about it and doing these types of things and trying to educate on the benefits. And so I think certainly as we do get into, as transactions start to spike, both from the sale of businesses and real estate revolving, I certainly do think that we're going to see more of it, and the use of it becomes a little bit more prevalent in those situations, certainly. So.
Yeah. Well, I tell you, Garrett, that's why we're thankful to have people like yourself that are out there, teaching and educating us on these powerful strategies and exposing us to these powerful strategies. And that's one of the things I love about, having the show like this, is being able to help get the message out there and help educate others. And really what it comes down to is, listen, we talk about this all the time. They don't teach these things in school, right?
They don't. Yeah.
You turn over enough rocks, and that's how you discover these things, especially as you go through this entrepreneurship journey. But again, thankful to have people like yourself out there that are, just our subject matter experts that we can turn to learn how we can continue to preserve our wealth, man. So really appreciate what you're doing.
Absolutely. Had another thought on the 1031 exchange that is applicable, and that in addition to the deferred sales trust being an alternative, it's also a rescue. So if you do have money sitting at the QI and you can't identify or close on time, the QI can enter into what they call as the defeasance agreement with the trust. And the money can move from the QI into the trust and preserve that deferral. So if you think you're going to blow it, and before those time periods hit, you can enter into that defeasance agreement and create a deferred sales trust and move the money out of the QI and continue to maintain the deferral. So it's a rescue as well.
See, that's why it helps to have people like Garrett on your team. So great stuff, Garrett. Well, unfortunately, man, we're getting near the end of our time. I think we actually went a little bit over, but man, what a powerful strategy. I know that we're going to get a ton of questions about this after the show. So I actually may have to have you come back so we can just continue to.
No worries. Absolutely. Would be glad to.
I appreciate that. So, but listen, in the meantime, tell the listeners how they can learn more about you and what you got going on in your legal practice.
Absolutely. So probably the easiest place to go is www.legacytaxstrategies.com for my contact information. But that's probably the easiest. You could certainly find me on LinkedIn and connect with me there. That may even be a little bit easier. Feel free to reach out, message me, connect with me, and we can open a dialogue. What we tend to do, we can certainly take a potential transaction and do the analysis, kind of some of the bit of the high level math to say, okay, here's the capital gains potentially that you could defer. And if you were to invest that over a 10 or 20 year period, here's the excess, essentially the extra income, the extra money that you would make on that delta that we were talking about, that money that you would otherwise paid to the government. Here's what that over a 10 or 20 year period, this is what that does for you in your pocket. So we can absolutely help clients with kind of that preliminary analysis.
Oh, love it. Well, Garrett, thank you again so much, man. Look forward to having you come back and help continue to educate us on this very powerful strategy, and look forward to keeping the conversation ongoing.
Absolutely. I appreciate the time today, Cody.
Absolutely.